Welcome. In this video is Xcn Bearish correction over. We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand. Looking carefully at the chart, we can see that there is a very prominent downtrend structure that has been putting pressure on the price for a long time. Along this trend line, we can see that the price action touches this oblique resistance many times, even repeating this contact several times in a row in some areas. In terms of technical analysis, a trend line with such a large number of contacts not only shows the importance that traders attach to that area, but also proves that the trend line is a strong resistance line. However, there is also an important detail that should not be overlooked here. The fact that the price has repeatedly touched this trend line, although it shows the strength of the trend, also causes this resistance to weaken over time. Because a common principle in technical analysis is this: the more times a resistance line is touched, the more vulnerable it becomes to being broken after a while. In other words, a kind of resistance fatigue occurs. This suggests that if the price approaches this area once again, a breakout to the upside may be more likely this time compared to previous contacts, especially if there is a buying pressure in the current market structure. If a close above this falling trend line comes, a technically important breakout will have occurred. In the event of such a breakout, it is likely that we will witness not only a short-term bullish movement, but also the beginning of a new uptrend in the wider time frame. This is because an upside breakout of a downtrend changes the positioning of most traders, and is often supported by stop bursts, short squeezes, and volume spikes. After such a breakout, the price may start testing the previous horizontal resistance zones. This suggests that potential targets could be areas that have served as resistance in the past. In addition, if the price rallies after this breakout, many of the previously uncrossable horizontal zones will be back on the agenda. This could create both short-term and medium-term opportunities for investors. Of course, this kind of technical structure doesn't always guarantee absolute bullishness. However, the fact that there are so many contacts to the falling trend line significantly increases the likelihood that a breakout could be technically much stronger and more sustainable. This is why this pattern is closely followed by many technical analysts and experienced traders, and is considered one of the primary signals when building a strategy. As a result, this falling trend line has now reached a critical point. If the price manages to break this trend line with an upside breakout, the technical outlook could turn positive. The closes and trading volume after the breakout will also be decisive in terms of the permanence of this uptrend. But we need to look not only at trends, but also at other metrics. Keep watching. When we analyze the chart from a broad perspective, we observe that the price is currently moving according to a certain pattern within the Elliott wave theory. According to this theory, the market moves in a 5-wave progression, followed by a 3-wave correction. At the moment, we can easily state that the price is making its last movements in the second wave, and then preparing for the transition to the third wave. Especially since the second wave is a natural retracement that comes at the end of the first wave. It is often a phase that traders look forward to, but at the same time, caution should be exercised. During this period, the volume, volatility, and momentum of the market usually decrease as buyers digest the previous rise, while sellers start to take profits. In this context, one of the strongest technical signs suggesting that we are approaching the end of the second wave is the Fibonacci retracement levels. When we look at the ratios obtained with the Fibonacci tool, plotted between the start and end points of the first wave, we see that the price retraced between the 0,618 and 0,786 retracement levels. These ratios are considered not only statistical levels, but also psychological thresholds in technical analysis. This means that many traders and algorithmic trading systems consider these levels as both support and reversal areas. Pullbacks to these levels usually either meet strong support or turn into a short-term consolidation process. The 0.618 level in particular is known as the golden ratio, and is a strong equilibrium point in financial markets, as in many patterns in nature. An upward reaction of the price after reaching this level may indicate that buyers are reactivating, and the second wave is about to end. The 0,786 level, on the other hand, appears in deeper corrections, and is a critical point where more cautious investors take positions. In other words, the area where the price is currently located marks a very important threshold both historically and technically. A possible rebound from this area could signal the start of the third Elliott wave. According to Elliott wave theory, the third wave is usually the strongest and most voluminous. During this wave, the price rises more aggressively than during the first wave, and the direction of the market is much clearer. Moreover, this is the period when traders make the most gains. However, relying only on Fibonacci ratios is of course not enough. In order for these levels to work as a turning point, complementary signals such as increased volume, positive mismatches in momentum indicators, strong green candle structures, etc., should also be seen. If these signals start to appear simultaneously, this could signal that the beginning of the third wave is very close. In addition, looking at the overall market structure, it can be said that investor psychology also plays a big role in these regions. This is because investors often become indecisive during the corrections that occur after the rise in the first wave. Panic selling, impatient buying, and wrong positioning are common during this correction. However, professional traders watch the market at such strategic Fibonacci levels and are often the first to catch the turn signals. For now, we will wait for an upward reversal from here. When we look at the RSI indicator from a broader perspective, we see a very prominent falling trend line. This trend line has served as a strong technical resistance that the RSI has touched many times before, and each time it has reacted to the downside. Each time the RSI has tested this level, it has made a slight upward move, but has failed to gain enough momentum and has retreated back down. This means that this falling trend line is not only a technical hurdle for the RSI, but also a wall of resistance that investor psychology dictates must be broken. Recently, however, it has been noticeable that the RSI is approaching this trend line again. If this time, the RSI manages to break above this falling trend line with enough volumetric support and momentum strength, it will not only be an indicator-based signal, it could also set the stage for a breakout of certain technical structures on the price chart. This is because leading indicators, such as the RSI, usually signal price movements sometime in advance. In particular, the RSI's trend breakouts are often taken as a strong signal that the price will break in a similar direction. From this point of view, the area that the RSI is currently in is a critical threshold. If the downtrend is crossed with an upward move, this would clearly indicate that the market has switched from sellers to buyers and momentum has shifted. In the event of such a breakout, an upside breakout of the long-lasting downtrend would be highly likely, similarly to the price chart. If this scenario materializes, both the technical indicators and the price structure will have confirmed each other, which usually signals the beginning of a strong bullish move. Moreover, the RSI breaking trend lines is important not only for the change in direction, but also for the strength of momentum. Because if the RSI breaks above 50 and breaks the downtrend, the price usually moves into positive territory, and investor confidence increases. This strengthens the buying pressure in the market. As a result, this downtrend breakout scenario on the RSI is not only an indicator-based optimism, but it can also be a technical turning point on the price chart, indicating that the ongoing pressure is over and a new bullish wave may begin. That's why the movement of the RSI in this area is of great importance for both short-term strategists and those who are trying to determine the medium-term direction. That's why we should follow the RSI indicator so that we can get the signal in advance. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.